Hello, my name's Austin Smith. I'm a co-founder and CEO of a local startup called Mission Control. Today I'll be talking about a startup founder's guide to fundraising. Like I said, I'm a founder of a company called Mission Control. Mission Control is a community platform for recreational gamers. I'll dive into that in a little bit and why I think that's fun and nerdy. But before we get into that, and to add to that first, we're a St. Louis company. We have received an Arch grant. We have our three founders are all graduates of St. Louis University, and we've been invested in by some local and Midwest institutional venture capitalists, including Dundee Venture Capital, Math Venture Partners, Cultivation Capital, and M25. What I'll be talking about today is how to strategize getting investment from venture capitalists. So what I want to talk about is kind of in three steps. First, types of businesses and how those types get funded. Secondly, I'll talk about Mission Control so everybody knows what that is, but also how that relates to our funding process. And then lastly, I'll give you my quick idea of the three-step funding process, what we used, what I think is a really effective way to raise capital for a startup company. It's not going to be the longest presentation. My purpose here is really to give you my overview, what worked for me, what I know has worked for a couple of other founders, and then kind of just create a place for open questions about raising capital. So, to start off, let's talk about types of businesses. To keep it simple, I'm just bucketing things into two areas. There are lifestyle or small businesses. These are businesses where they can make a lot of money, but their main purpose is cash flow and cash flow right away. They might be sold for some big amount later down the road. They might be valuable, extremely valuable, from nothing to something extremely valuable, but their purpose is cash flow. There is plenty of risk involved, but it's not high risk, high reward. These are companies that you might see golden gems in the foundry where they're selling really cool stuff, but there's nothing that's going to take that business and turn it into a $3 billion corporation overnight. There's no underlying technology that flats that. Now that doesn't mean that they can't go do that. There's a lot of things that can happen. But the main idea when you're starting a company that's more retail or more restaurant focused, it might not be the type of company that has a venture backable underlying idea about it. So what I'm going to talk about is more about and more relevant to high growth and high risk businesses. These are typically tech businesses because tech businesses can scale really fast with less cost to scale. Typically there's an underlying technology that adds value and causes a reason for a $1 billion valuation or bigger underneath that. So St. Louis companies, again, you've got Mission Control and you've got Belto, both tech companies, both venture backed and so on. This is an oversimplification, right? A lot of some small businesses or lifestyle businesses can apply this as well. They might be able to. I don't have experience in that. They also might be venture backable even in the situation from that perspective. But to oversimplify things, when you have lifestyle or small businesses, the funding strategy might be a little different than a venture backable, high growth, high risk, high reward business. And so today I'm going to talk about from my experiences, and that's on the high growth, high risk, reward business. So, to give some...
Can we ask questions now?
Yeah, sure, let's do it. Go for it.
Well, I just want to know when you say lifestyle businesses, small business, what do you consider that to be? Like, what is an investor would have to, how much? 5 million, 10 million, 20 million?
Hey, this is a great question, and let's keep on asking questions throughout the process. The biggest thing is if you're going to put $1 into Mission Control early on, because esports, we're working in the esports space. I'll tell you about more of it soon, but we don't know if it's going to work, right? Like what we saw is a gap in the marketplace, and we're like, listen, we think we can apply something to this marketplace because it's pretty darn big, but it might not actually respond. So if you're going to give me $1, you're going to want at minimum 10 back. Or if you're giving it to me, if you're the first person to give it to me, and I've got really nothing but a good survey and minimal viable product that I spun up in a weekend, you might say, no, I'm looking for like $50 back from that $1. It's very high risk, very high reward. Now that changes as the companies get more mature. If you're looking at where we're at now, where Balto's at, you're probably looking for 10x rewards, 5x rewards off of your investment. Whereas something from other businesses, you might say, oh, I don't need you to give me that reward right away, but I want you to give me, cash flow every month. And that's the other thing about mission control versus other lifestyle businesses is you're going to get probably one payday from me when we sell our business, and that's it. And in between the day you gave me the dollar and the 7 years that it took me to sell the business, you're not going to see anything. And so it's just a different strategy, and it's a strategy that venture capitalists are used to with high growth, high risk, high reward businesses. Lifestyle businesses can work differently. And there's a million different ways. I oversimplified this highly in this way, but that's the two categories I'm kind of bucketing them into to simplify. Does that answer your question all right? All right, now I'll tell you a little bit about mission control. So I grew up playing games, video games, board games, sports. Doesn't matter what it is. I'm not really good at any of them, but I still like playing them. So you can see a couple weeks ago, me and my friends, we won our volleyball rec league championship. I'm very short for a volleyball player, but I'll take it anyways. So we had a good time, and most of the time, I mean, this is what we've been in 12 different seasons. We finally won. We're not very good. We lose most of the time. Soccer as well. But we keep on going back. We pay another $800 as a team to go play another session of soccer or volleyball or whatever it is, because not that we enjoy soccer or losing or pulling muscles, what we enjoy is that time together. And so after you lick your wounds from losing the game, you go to the bar afterwards, you drink a couple of beers, you spend time with friends. The whole point is that volleyball here isn't the real point. Volleyball is a medium to the real point, which is community. Out of college, I started working with my co-founder at Stadia Ventures, where local venture accelerator that invests in early stage sports and esports companies. And we learned a lot about these two industries. And one of the things we learned is that these two industries, they look rather similar. The traditional sports landscape has professional stuff. It has amateur leagues. It has varsity at both high school and college. And it also has, where we play volleyball and soccer, this recreation industry, where it's got 51 million people in the United States who play team-based sports. And we looked at esports and we're like, hey, there's also a professional circuit. There's also an amateur circuit. There's varsity stuff for high school and college esports now. But there was one place that I played games growing up. I played rec sports, but there was one place that wasn't addressed, we felt, and that is 179 million people playing multiplayer video games, over 225 million people in the United States playing video games, and yet there was no structure to it. There was none of that purpose-structured community point around gaming, just pick up gaming, like pick up basketball, if you will. And so we're like, hey, there's probably an opportunity here. We tried to find a company to invest and we couldn't, so we left to build it. And so we built Mission Control, a community platform for recreational gamers. It's a two-sided tech platform where admins can get on our web app to create communities and then host esports activities. Not too different from our rec league volleyball over the summer or rec softball at a college intramural, but for video games instead, so FIFA, Fortnite, or whatever your favorite video game is. They host those activities from our web platform, and then players can download our mobile app where they join these communities, register for these activities, find out when their games are, communicate with their opponents, submit their scores, all that sort of fun stuff. The main reasons any of our organizations work with us is that they are either receiving an amenity, people want to stay involved with them, they can charge people for these leagues and receive some revenue, they can find some data about who likes to play FIFA and therefore what else can you advertise to them that might be soccer related, or it's just a simple way to run esports leagues that they might already do but just over email and Excel. We charge these groups as a SaaS plus business, so this is where it becomes super scalable. People can charge us we charge them an annual fee based on how many how many members they want in their community, and then we can also take a transaction fee off the top if anybody takes charges for them to join these leagues or activities. Because of this setup, we've worked with over 300 organizations across the recreation industry and brands that are related to entertainment. So this includes City of Las Vegas, the University of Kentucky, GameStop, Cinemark, and so on. And the number one reason why anybody cares about us is because we have a lot of engagement. If somebody shows up for one game, there's a 91% chance that they'll show up for half the games that you schedule them. 67% of them show up to every single game scheduled for them. This high engagement and the ability to scale that across organizations, 300 organizations with a small team, is why we are incredibly scalable. It's why we have that high growth possibility. It's why we have that high reward, but we also have that high risk, which is why people are expecting that large return. So that's mission control. Before I move on to that section, does anybody have a question about what mission control is and what we do? All right, so now I'll discuss the three-step funding process that comes for venture-backable businesses and worked for us to set up that success. It's 3 steps. This is my only slide on it, and so I'll run over that, and then I'd like to set up a discussion. So when you are fundraising, the biggest challenge you have is that full-time venture capitalists have a lot of deal flow, and yet you have a little bit of people to talk to. And if you string it out over a long period of time and you say, oh, I'm just always looking for money, then you essentially put into a place where they always know you're there if they want you, but they never have to pull the trigger and invest in your company. So you have to essentially create some FOMO. You have to create some sort of reason why if they don't say yes today, then they lose out on the opportunity. Because if you're going to ask them tomorrow and the next day and the next day and the next day, then why wouldn't they just wait 4 days to find out if you're still in business? They can get more information every single time. So you have to be able to create essentially a window where they can have the opportunity to say yes or say no, or they win or lose the opportunity to work with you. It's creating that fear of missing out. If you can't create that, then you might not be able to get investment at all because they'll just keep on kicking it down the road. And I'll tell you this experience from my side. When we first created our business, we put together a MVP survey, got 3 customers on board, and we brought in $100,000 from that. From friends and family who were interested and say, hey, that seems like a good idea. The next time that we used that $100,000 to build a real tech foundation to start bringing in more customers, but then we started trying to raise $300,000. Just $300,000, we already did 100 and shouldn't be too hard, and now we've got 60 customers. But we kept on doing this process where for 6 months, I just met with a whole bunch of people, said, yeah, we're kind of raising money. I would love for your investment. And everybody's like, okay, but like who else is in? You know, what are the terms? Have you guys done anything big recently? And the answer was always kind of like yes. Like I'm talking with a lot of interesting people. We're signing new customers left and right. But there was no one moment that said, invest now or you will lose out on your opportunity. And it took 6 months for us to get those $300,000 in the door. And most of that was because we never put it down and said, hey, this is your opportunity, take it or leave it. And that's a really thing to do as a founder because you need the money. But how can you make it so that you don't have to take one person's money? You can choose between a group of people where you can say, well, this person's the best fit, this is the best deal. You have to set that up, and that takes some strategy. So this is the method to the madness. So that was when we tried to raise $300,000. That was in 2019. And in early 2020, we signed GameStop as a customer. We monetized our 60 customers, and suddenly we had a really interesting inflection point where we could raise some venture capital from institutional venture capitalists. And this isn't even mine. This comes from some of my advisors suggesting, okay, this is how you set it up. First off, you do 2 months of preparation and connection, where you tell people you are not raising capital. Now, secretly, if somebody offered you a deal on the spot, there's no reason you couldn't take it, but you sit down with people and you say, I'm not raising capital right now, but I will soon, and I just want to tell you about my business, and I want to hear your feedback. This is essentially the portion where you're getting the answers on the test before the test starts. You're putting your study guide together. And there's two things you need to do during this 2-month period. You need to build your contact list, because eventually you're going to send one email out that says, I'm raising money, and are you interested? And then you need to basically build the documentation that people are interested in. So when I say documentation, I say your pitch materials, the things that you'll send to people. So for me, that meant a pitch deck, similar to this one. This is an adaptation of our original pitch deck. And then our pro forma financial statement. You might also add an executive summary. You might put your old financials together. Whatever that is, you're kind of creating basically a couple sets of files that makes it easy once people ask questions to share. But you're not sharing this yet. You probably shouldn't even share your pitch deck yet. So for those 2 months, we did two things. One, I set up a advisor council. We met every Friday at 9 a.m. for essentially 8 weeks, and we did pitch them every week. And sometimes we would get through 2 slides because I would have to explain the story differently, and people would say, that's silly, you're not talking clearly, or whatever. And basically, it was just 5 trusted people around us that put a lot of time into working with us. And by the end of that, we had a really good pitch deck, a really good story. We knew how to do it. We were very, very comfortable with how we talked about mission control because we did it for 8 weeks. And it was with friendly people, not investors who would say no because we were messing up in front of them instead. The second thing is that I went and talked to the investors. I literally would send them an email, say, hey, you're a venture capitalist. I'm not raising money right now, but I plan to soon. But I'd love to talk about mission control, and I'd like to hear from you what you have to say. And a lot of people would say, well, this is really interesting. And I would typically ask, okay, so what would make you excited about investing in a company like ours? And they'd say, well, I'd like to see, what your customer cost, your cost of acquisition for customers are. Or they would like to say, well, I need to know what the lifetime value of a customer is before I invest in something like this. Or I'd really like to see your list of all your customers. Well, I said, yeah, well, good thing I'm not raising right now. You don't need that information now. But what I did is I turned around after that meeting and I went and calculated the customer acquisition cost. I went and calculated the LTV. I went and got that list together. And those were the documentations I put together, because now when I eventually did ask them for money, one, I told them the answer before they had to ask the question, or I knew they were going to ask the question and I just had a slide later in the deck and I didn't have to waste my time on it. Or after the meeting, I just, they'd say, hey, why don't you go get this together, because I know this is a big question to ask and it might take, a week for you to get this information. I'd send it to them 5 minutes after the meeting saying, here you go. Made us look really up, like we were buttoned down, we were ready to go, and we were answering questions before they were even asked. So that's what you do during that time. And the nice part about that is that people let their guard down. They're not asking me for money. And they will share honest opinions, and they want to be helpful and advise you. And this is a two-way street too. This isn't essentially setting up a way to manipulate investors. That's not the point. The point is they want you to not waste their time. They want you to be really good. They want deal flow. So it's also important to understand what's important to them. So walking into that, if just like coffee with anybody else, you can also ask, how can I help you? A lot of people are interested in deal flow. That's how a lot of these people are, venture capitalists and investors are measured on their success. So besides you building a good company that can make them money, you can also be like, well, here's my 4 friends. They're also starting companies, and I think you should look at them as well. Because again, they're measured by that. So if you can be helpful to them, they'll be helpful to you, saying, I need to know this data point before you pitch to me. And you help, both parties are helped, and now you're set up. So after that 2 months of preparation, where you get the documentation together, where you create an email list of the people where you eventually want to reach out to, you have the beginning of the fundraising sprint. For us, this was February 1st, 2020, and I sent one 4-sentence email to 70 people. And I said, hey, we're Mission Control. As we spoke before, we do this. We're a community platform for recreational gamers. We just signed GameStop and 60 other groups to a deal, and we are officially opening our Series Seed round. And I'll be in your city, because this was all national, it was international. On these days, can we set up a meeting? And that last bit was the most important part, is that we said, hey, we're going to be in your city, and we had a limited time, let's just go meet. Now, sometimes I didn't even really have meetings in that city yet. I would just say I'll be there, and then I'm going to show up, and it kind of became a self-fulfilling prophecy. But you send that out to 70 people, those 70 people say, oh, you should meet with these people too. I ended up probably, 55 meetings in 20 different cities over like a 30-day period. And that's that 1 month sprint. I was just on planes back and forth. I'd meet with whoever. I'd talk to service providers like your banker, your insurance broker, accountant, lawyers. Our banker was the one who introduced us to the eventual firm that led our round. So you tell everybody that you're raising this round and they can introduce you to people, and suddenly it becomes this network effect where I'm in New York talking to someone, and they say, because the venture capital community is small, they said, oh, I was just talking to my friend in Chicago and they said they met with you too. Fear of missing out. They know that there's competition because I'm being talked about in these little circles, and that's half the point of making it during 1 month. The other bit is that now there's a timeline. If somebody doesn't give you an offer sooner than the other person, then you might miss out on the deal. And so it kind of just creates this 1 month sprint where you can expect, or you communicate, hey, listen, I'm talking to a lot of people. If you don't get a deal together in front of me by March 15th, 45 days later, then we are going to probably take another deal. And it gives you, as the founder, as the CEO, the ability to make decisions. You have options now, and those options are powerful because now you can say, hey, well, that price isn't good enough for me. I'm going to need you to go up in price if you're going to invest. Or hey, I like this group later. They're a better fit for our type of company. So I'm going to take them instead. And so that's what happens, is basically creating options. You send one email that basically is who you are, what the traction is, that you're opening your round, and then, hey, I want to talk. That's 4 sentences. And then you send it out. After that, you just kind of gather deals and close. We decided to have term sheets come in on March 15th, 2020. If anybody remembers that year, March 15th specifically area, it was a little bit crazy. So we ended up delaying it a month, and at that point we were able to sign terms with a leading venture capitalist. Then they would only take about half the round, so we got to go back to everybody else and say, well, I want you in the round, I want you in the round, I want you in the round. We got to pick our favorite people who we felt would be most impactful on our future and add them to the round as well. And that's the closing period where you find the people to fill the rest of the round. If it's not filled by one person, you agree to terms, you share your documentation, all the rest of the stuff. You don't have to worry about getting every little thing ready in that prepare period, because you'll have this closing period after the term sheet is signed to get to, before you get the money, but they're doing their due diligence, and that takes about 2 months as well. So that's how I went through it. Can dive into a lot of these things, but happy to answer questions now. Mr. Weaver.
Was this round on, did you do equity or did you do convertible?
So this was a priced round. It was equity, yes.
So did you do Series C?
It was a seed, yeah, Series seed.
So say that's pretty much cut and dry. Take it or leave it type of nice deal. I mean, it's not negotiable.
Right. You could negotiate. I've seen A's happen like this too, especially. I have not done a Series A round, so again, I don't have that experience. But I've seen them happen like this before. The person who taught me this exact strategy went to like Series C, D with this exact strategy. Now time changes when you got offers on the table, and you can choose between 3 or 4. You can dictate terms a little bit more, and that's the whole point of this process.
When you went back to the, you got the initial investor, when you went back to those, did you kind of lose a little bit of that leverage of, hey, I've got options now, or did it not make a difference since you already had the lead investor?
Oh, yeah, no, it did not make much of a difference. I mean, a lot of groups say, I only lead, or I only follow, or I'll do both, and again, it's a small industry. They know that somebody might have offered to us. And they're like, no, that would be great. I would love to be on that, which was the case for us. They're like, well, we don't lead anyway, so we would like to be on
Makes
that.
sense. Thank you.
But it,
I was just going to validate that I've seen your process work
Well, once you get the lead on an A, and then you go to this, I've seen this process work really well too with seed round on convertibles and safes with just a term sheet, and you drum them up. I mean, what you did as a process is beautiful.
And that's the whole thing, is processizing fundraising. Yeah, like you said, and it does change per the type of fundraising you're doing, similar to those 2 buckets I started with. But the whole point is processizing it, time blocking it, being very intentional about it, and honestly, when it comes down to it, it's just creating a little FOMO so that you have the upper hand in these discussions. It's not one person gives you a deal and it's a take it or leave it sort of situation, even if you have multiple deals over a time period. What other questions do we have?
What was the state of your product when you first started to go out and push for fundraising? And how did you kind of look at what you were building and understand when that jumping off point would be?
The most important part on that is just matching the state of your product and business to the investor's expectations. Because there's investors at every step of the way. There's idea investors that don't need a single thing to exist. But there's also Series A investors that require essentially $1 million in recurring revenue at minimum, and product market fit, and a go-to-market strategy that's very evident and you can't have any question marks around that. So for us, our first raise at $100,000, we had literally did a survey, had 3 non-paying customers, and had a Squarespace site that we did Google Docs on the back end of. Like, that's not a product, that's a theory. That's just an idea that we had some really good data on. But we raised money off of it. Soon after that, we were still running off of that. And building the actual tech product foundation. But we got 60 people to sign on, and 60 different colleges to sign on and say they want to use our platform for rec leagues. And so it was just sales traction at that point that got us the next $300,000. Then eventually, we got those 60 groups to pay and GameStop to pay, and we also had our product just launched, like very recently launched, so it wasn't in good shape. It wasn't a great product by any means, but it had some very light revenue. We had multiple customers, and we had a big customer being GameStop, and we were able to raise just under $2 million on that. So it just really matters to where you're at. Our next step, if we're following the nice clean line up, is we would turn those 60 customers and GameStop into a lot more customers that collectively are paying us $1 million annually, and then being able to turn that into an A round. Each step you take should be essentially, I'm going to raise this money that will get me to this next round. That's how you know how much you need to raise, because you can calculate, okay, well, I'll need to hire this many people, and I'll need to have this much time to have X sales a month that will eventually equal this amount of revenue, which is what a Series A investor expects you to have, $1 million in revenue or whatever that is. When you don't know what that next investor wants, that's what that 2 months of prep is, right? Again, you're getting answers before the test. You can find out what people expect of you. So let's say in that first 2 months for us, we didn't know how much money we needed to raise because we didn't know what Series A investors would expect. Once we started asking them, they're like, oh, well, you need to get $1 million in revenue. Well, before I went back and started asking people for money, I was able to calculate how much money we would need to get to $1 million in revenue. So again, it's asking questions, processizing, and time blocking.
Oh, thank you. Could you maybe take me through the logic of, after you had enough investors to theoretically get the funding, whether it's through Series A, B, or C, maybe take me through the logic. Did you set terms ahead of time and then negotiated those terms, or did you, I don't know, were you looking for anything specific within like hands-on, hands-off, et cetera, or anything else outside of just the money? So, hey, you got some options for money. Are there any other terms that you considered?
Yeah, I mean, all the terms matter, but when it came to us, we were looking for people who were interested in helping us on product, people who had experience with our types of businesses, so whether that's SaaS or esports/gaming area. I mean, Cultivation Capital has Brian Matthews on it, and Brian Matthews did a lot with fantasy sports, and we see our product as similar to fantasy sports in a lot of ways. So having Brian Matthews involved with our business is a huge win. So take out the fact that he's from St. Louis. Like, it would have been a huge win if we were in any other city in the country. So that sort of targeting is absolutely a reason why we choose different investors. I mean, we had the opportunity to have 2 investors in our round, and we went with 4 instead because the second one didn't offer enough value to take a big check and take the rest of the round. They didn't offer enough added value, so we said no to them and had 3 other smaller checks come in from other firms because we thought they were more valuable. M25 is a great group out of Chicago, and they put on founder summits that introduce you to other founders in the tech space and introduce you to a ton of Series A, B, C investors from the coast, the people who can really get your money going, get money into your business and get your business going if you're starting to find a lot of success. And we wanted access to that. We thought that was extremely valuable, so we made sure that they were in the round. But you don't dictate all the terms. I mean, doing this just allows you to have choices, right? And still, the venture capitalists are going to put what they see together. And again, if you met with 50, 70, 100, 150 people, you're going to know who are your favorite. You're going to know who you connect well with, and they're going to know it too. And the people you'll kind of guide towards each other. So, what other questions do we have?
Can you talk about the specifically, like, you sent out emails to 70 people, but like, was that all cold emails? How did you do outreach and get connected?
They might have been cold in the prep phase, but I've already had a meeting with pretty much all of them during that 2 months of prep where I would send them the cold email and I would say, hey, I'm not raising yet. We're thinking about it soon. This is what we do, and I would love to get your insight on it, right? You use your cold emails during that 2 months. Like, get as many as you can out and just tell everybody you're not raising, but you're about to, but I want to learn first, right? Use that period as your cold outreach so that when you send that 1 month fundraising sprint, everybody knows who you are. They know you're serious. They're excited because, oh, I've been waiting for this because I talked to this guy before and it was really interesting. So that's, yes, you can add some cold to it, but like, I think the strategy is much more make them not cold in the 2 month lead up or 4 month lead up, whatever your strategy is. But then on the day that you go, they're not cold anymore.
I had a question. You know, you're talking about venture capitalists and so forth, and I'm working with several companies to find venture capitalists for their products or services, or even like one is a resort. And when you say call them, I can't seem to get phone numbers or emails for most of these people that work in venture capital or any other. And then when I do call or email, I get no response. And I tell them what I'm doing, and these are 3 different, projects, and I get no response whatsoever. And I don't know what's going on. Maybe I'm doing the wrong thing, but these are pretty big projects. We're talking about, $6 million, and the other one is about $150 million. So I would think either you tell me yes, you're interested, or tell me no, but they don't respond at all.
Yeah, it's not the easiest thing. Trying to get a response does make sense. I mean, that's your goal, and cold outreach works, but it's also difficult. So number one thing is targeting and fit, just like you're doing sales for your business. Like, you want to make sure that the venture capital group is fit for the type of investment that you want to do, fit for the stage that you're at, fit for the industry you're in, all that sort of stuff. But in that angle, you can try and cold email, cold LinkedIn, cold call as best you can. But you also have to remember, a lot of these guys, they're in the business of talking to as many people as possible, seeing as much pipeline as possible. So they're incredibly busy. They get a lot of inflow. So without question, the best thing is a warm intro. So if you can find a way through LinkedIn to just say, hey, I'm just interested in talking to this individual. Can you just put me in front of this individual? Just send my deck, or just can you just make a quick email introduction. a lot of them aren't going to go places. And to get 70 warm connections, you might need to attempt 500 different times. I'm not sure on the exact numbers there, but it's what I will say is that of the people we talked to, there was at least a lukewarm connection to 98% of them. So yes, you can cold call, yes, you can focus on that, do what you gotta do. I mean, get on Twitter. A lot of people are on Twitter and just sending DMs to potential investors, and that works because Twitter's where that information is shared. It's where a lot of venture capitalists are. But my suggestion would be get as many warm intros as possible. And that's why I said, ask your service providers. You know who needs accounting? Venture capitalists too. You know who needs a bank? Venture capitalists too. That's why find really good, especially like Anders is a great local accounting firm that we use. They work with a lot of startups. They know who these other startups have investments from. They have relationships with them. So you sit with your accountant and say, hey, could you make a couple introductions for me? Or do you know this person? A lot of this stuff is public information on LinkedIn. Just get on LinkedIn and find out who your second degree connections are and ask that person. It's a lot of relationship building. A lot of that, that doesn't take 2 months of time necessarily. That's, you coming to these events and saying hi to me, and then I know Cultivation Capital, right? Like that sort of relationship building might come in handy when you do your 2-month prep. But that's why being a part of the St. Louis startup community, coming here and being active is a great step one. Should I probably add that above the preparation and connection is get involved in your community, and then use those warm connections to talk to the decision makers. But yes, you can cold outreach, especially if you got something fancy or you happen to be working on something that has cool buzz like esports did a couple of years ago. Those happen to work better when you're doing cold calls. We have a mic for him.
So I have a two-part question. First being, did you get the Arch grant before you did your fundraising sprint?
No, we got it afterwards.
How influential was getting or doing the fundraising sprint to getting the Arch grant?
I would think that after we got our funding, that it made a lot of sense for Arch Grants because we were obviously a company that we had a couple $1 million worth of capital, and we knew that we were going to hire and stay in St. Louis and grow in St. Louis, so it made sense for Arch Grants and us to connect, and that worked out. I would say in most cases, it was just weird timing for us because we happened to raise this money in January, and they make their decisions in like November or right before that. So like it was just weird timing. We weren't ready by the time from the last cycle, but we were definitely ready for the next cycle. In most cases, I would say work hard on getting those early stuff, and then if you get an Arch grant, it's $50,000, that's awesome. That really does help. And you stay in St. Louis, great community. But Arch Grants is going to make all those warm connections for you. They've got the list of thousands of people. So if you can get an Arch grant, and then you set up this plan, and you start talking to all of the advisors within Arch Grants, you'll be able to do this. So we kind of did it backwards. I would say get the validation of Arch Grants, get that $50,000 in the door, they're the community you want to be a part of in St. Louis. I mean, that's a big win. Now, it doesn't mean you have to. Like I said, we did it backwards, and it's still valuable. But if you could do it that way, that's what I would say the perfect setup is. But don't use it as the only way. Don't not get an Arch grant and then say, oh, I can't do the plan now. Keep on hustling.
Any other questions?
My email is at the bottom here, austin@missioncontrol.gg. If anybody wants to chat or has any other questions you want to ask personally, I'll be up here.
What's your favorite part of the process?
Part of the,
What's your favorite part of the process?
oh, I mean, I'm a nerd. I like all, maybe the Excel files. That's that type of nerd. The prep side is really interesting when you're kind of saying, hey, wow, this could be a really good business. This is a really interesting business, and I like that a lot. But, I mean, I got to do like 21 cities in 30 days or something like that. I love travel, so bouncing around and becoming like the fanciest second row Southwest flyer, like that was fun too. So I like talking to people, so that 1 month sprint was crazy, it was tiring, it was very interesting. So.
You mentioned that founder summit in Chicago. Would you have
The venture capital firm M25. Yeah, so that's only for their companies, and then they invite venture capitalists to it. But they're a top tier firm.
Hey, thank you so much for walking through this. It's super interesting.
Of course.
So where is Mission Control now in your?
That's a great question. So we raised that $2 million over 2 years ago, and as any startup, it's not a straight line. So we struggled with product for a while, and we weren't able to hit that $1 million in revenue goal that would allow us to essentially keep on going up. So instead of going up, we've had to go kind of stagnant sideways. So we've released some really interesting product recently. We're working on some great pipeline of customers, and so we've also been raising additional capital to make sure that we can stay in business and basically still get the opportunity in front of us. But there's a whole other talk on how to stay resilient when you get slapped across the face as a founder. So that's another one. We'll do that with we'll do that with coffee or with beers later tonight at the Startup Showcase. But that's what Mission Control. We're still here. We got 5 St. Louis employees. A couple of them are sneaking around in this room, and we're hustling.
I was just going to let, if you're new to this, one of the great resources I send a lot of my clients to is the Kauffman Foundation does about twice a year through Techstars. They do a whole series. Now you got to commit quite a bit of time. They basically simulate the whole, especially more for like a Series A round. And I actually took 5 of my tech clients through that process. And it kind of really opens your eyes. When we exited, we only owned 20% of the company. You know, I mean, we simulated the whole, like all the way through, you know, if we actually had this fictitious company and then we got investors and then, but it's, I can't remember the 2 gentlemen, they wrote a book and they the book kind of follows the course. And I'm drawing blank now on the name of the book, but if you check out Techstars with the Kauffman Foundation, I believe they do it about twice a year, and it's free because it's funded by the Kauffman Foundation.
Right.
So, but it's a great course. I learned a lot because I didn't really come from that side of the world. So.
And I think that's one of the reasons why there are so many entrepreneur support organizations, because there's a lot to understand. There's a lot of questions to be asked. There's a lot of questions you don't know to ask. And Byron, my co-founder, and I, we worked at Stadia Ventures. So we were in an accelerator before we started our company, but we learned a lot about startups because we went through an accelerator just by working at it. But that's why we are so lucky in St. Louis to have so many different accelerators and entrepreneur support organizations. So the answer is really just use them. I mean, you guys have already taken the first step because you've made the step of coming here and getting out in the community, so that's awesome. But if you're into fashion, there's something for that. There's sports, there's bio, there's fintech. I mean, there's everything out there. And there's arts grants, which is just staying in St. Louis. And each one of those groups can get you the warm connections, for that first stage, which is really important. But they'll also help teach you what the Kauffman Foundation and others will teach you, and just like what to expect when you raise money. And hey, yes, you might only have 20% of your company at the end, but that's okay. All right. I'll be around if anybody wants to talk. Thanks so much for coming.